Hey everybody, Ash Brown from Empiraa. This is the second Cut the Fluff with Daniel Callegari from Expert Business, which is great. Our first session absolutely went crazy. People really wanted to understand a lot about how to sell their business. It's something that people are pretty passionate about, which is great. It's interesting. It's an interesting part of business that people don't really, they always think about, but never actually get expert advice, which is great that you've got expert business. And this week we're all about how to value your business. So, Daniel, welcome.
Thanks, Ash. Thanks for having me again. And yeah, glad to hear that the session went really well last week. It is always a pretty popular topic. It's something that every business owner will have to come around to and exit their business at some stage. But yeah, look, we covered last week. The earlier they can start thinking about that, the better. But yeah, today, it's great to be back and talking about more specifically like the valuation piece, which is normally the first step in the process. And that's where we assess the value and then be able to, off the back of that assessment, make some strategic decisions and, build some value if need be, and then, align with that target valuation like we spoke about last week.
Yeah, and probably it's a good one to kick off with. Like, give us some sort of understanding on how is a business valued? And I know it's a very open question, but like so many people sit there and they go, "Oh, my business is," they might have a mowing business, or they might have a startup, or they might have any sort of business, and they sit there and they go, "Well, this business is worth $10 million." Like, what sort of these real key indicators? What's the things that kick in the multipliers? What are the things that really sort of help drive business valuation up?
Yeah, okay. So there's an old there's debate where like is business valuation like either an art or a science, and the answer to that it's both, right? So you can definitely do like a desktop valuation and look at the financials and like add back all the personal expenses and work out what the bottom line, what profitability is that business making, get that true value, because I think that's the first step. I mean, that's just one side of the coin, okay? Where and we can get into that a little bit as well. Whereas you're really undoing a lot of the accountant's work. So you employ an accountant or engage an accountant to minimise your bottom line and for tax minimisation purposes. And then what a valuer will do is undo all the accountant's work and bring that bottom line, your net profit, up to the true value. And then what happens is that once you've got how much that business is making, then we would apply a multiple. If you're looking at a capitalization of earnings type of method, but it's not the only way to value a business. But that's just one side of it. So that could be done from a desktop. That could be done like by assessing the financials, and that's something that even a broker could actually do a bit of a back of the envelope type of scenario. And work out the add backs and then apply an industry multiple, and that'll be like a rough way to value a business. But the thing is, the other side of the second side of the coin is the more complicated part, and that's more like the art part, where you've got to really look at and interpret the risks, and you've got to be able to factor them in. You've got to look at the scalability of the business. You've got to look at where that ceiling is, and how far. You could scale the business, for example, if it's got a worldwide application, if it's just really local. And you've also got to look at like the risks involved with key person risk. You've got to look at owner involvement, which we covered last week. So really, you've got to assess these things. And if you can, there's different ways to do that. But, you could look at like looking at these factors and then scoring them, and then, really looking at how your business is fits and rates in these key risk factors, and then really blend that in. And then what happens is when you're applying a multiple, right? You've got like say you've got an industry multiple, you could probably obtain one from a business valuations newsletter, let's say. And then what you could do is say, where do I fit on the multiple? It's do I fit on the lower end at 2, or am I at the higher end at 3 times multiple? And the answer to that is all the factors that we just explained, like the risk, like how your business model is, like how your revenue model is structured, and they all factor in, and where you scale on that multiple. So that's where the judgment comes into it, and that's where like it's more of an art and interpreting the results, and that's where like your business owner really can't do, and is not a really good doesn't apply good judgment because there's bias in there, right? So yes, if you've got a business owner that actually had to self-score themselves, that actually score themselves at the higher end, but then looking at someone at arm's length could actually look at doing an arm's length like assessment, which is unbiased and looking at objectively, and that's where you need to look at it from how a buyer would look at it, and that's where it's difficult for a business owner to self value their business.
Yeah, it's probably, I mean, we always go back to we touched on it last time about the emotion of the business owner. And they're always going to sit there and go, well, there's an old saying, people will pay what it's worth in their eyes. And so I think that's probably one of those situations sometimes where business owners think, oh, well, we're worth X. It's like, well, actually, have you got the structure and all, as we discussed last week? With the multipliers, so that's a really interesting topic there. Because you hear some people talk about multipliers on revenue, some people talk about multipliers on EBITDA. Touch on sort of what's sort of the common multipliers that about. Obviously, then obviously with some businesses it's stock and goods and property and all this other stuff. So it'd be really good to understand how multipliers are applied and what part of the line items that they're applied to.
Yeah, okay. So the multiples are applied to what's called the adjusted EBITDA, right? So that is, at the end of the day, that's what you're truly making. Okay, so you're adding back like, say depreciation, interest and all that as well. And this and personal expenses, discretionary income and everything is discretionary spending. And then what happens is so that's what it's applied to, the multiple. But essentially a multiple is a shorthanded a way of multiplying of valuing your business. So it's a shorthanded DCF method. So it's on the income approach, but what happens is it actually factors in to the different multiples that for example, let's say manufacturing is at let's say a 3 times multiple, and let's say a service-based business is at a 1.5 times multiple. The differentiating factor of that is the actual industry-specific risk that's included. So, for example, if you've got import and distribution, you've got channeled sales, for example. That is a lot that there's risky if a business owner was to purchase that, rather than if you had a shop front where you wouldn't be able to make any money if people didn't walk into your shop front and actually spend money. So you're on a week to week, you need to sell every week. And that's something that is a little bit more risky. The cash flows are a bit risky. Take for instance the SaaS business, which is on subscription revenue, and you're an essential. Your software is essential to that operation of the business. Well, then that's going to be hard for somebody like to for example, let's say Empiraa. People like a lot of advisors are using Empiraa as their source of they're using Empiraa, the software, to be able to provide service to their clients. So what happens is that's not easily replaced. So that would be easily that's quite sticky. So what happens is that would be considered at being scaled at a higher multiple. So really industry specific risk is important. Without going into, I didn't want to get too far into like the methodology, but if you did a discount cash flow valuation, what happens is you have a discount rate, which is built up. Industry specific risk is in there. You've got your risk-free rate, which is the interest rate. And then what happens is you've also got like key person risk and so forth. And it starts to build up quite high, depending on, the specific risk. And it applies to, for example, like, venture capital, for example, you'll see discount rates being very high because there's a high amount of risk versus, like private equity. And even for private businesses as well. So and it comes down to like what discount rate is the return on investment that an investor would probably expect to receive in return that's commensurate with the risk they're taking on. Okay, so it's really based on that. So the multiples are a shorthanded like a quick way for people to instead of doing a discount cash flow valuation, it's a capitalization of earnings that put a multiple on there. But it will reflect generally if you did a discount cash flow valuation and you did a capitalization of earnings, you should probably be able to come up with the right and the same figure, in theory.
Yeah. Yeah. What's one thing that business owners generally get wrong about their valuation? Like that's that's a really like I might think my business is worth X, and then sometimes it's half of what that is. So what's something that what they generally get wrong? What's the one thing that sort of or a couple of things that they sort of go where you have the painful conversations, I suppose you want to call it.
Yeah. Okay. So look, in two businesses that could be earning the same amount of money, right? And then they obviously have like a different multiple applied to them. Where they get it wrong with most business owners, and this is going back to what we spoke about last week, a lot of owner, like non-transferability of the value, right? So your business will be worth more if you can actually transfer the value to a willing buyer or an acquirer, okay, without any churn, without any like leakage of value or loss of value, right? So if you can transfer, so if you're an example, if you've got 3 years of contracted revenue that can't move anywhere and that contract passes on, well, that's a lot, like more desirable than, let's say, service-based businesses that have handshake agreements with, with real estate agents, for example. So, that's definitely something that that business owners can get wrong a little bit. They can say, okay, well, I'm earning this money, and someone else can come in and be able to, basically do what I do, and that income's going to be, secured. The other thing is that the team that you build, okay, and the team that you build and your staff, that is, we can't really put that into the valuation because the team could leave from day one. Okay, they could all walk, right? So it could be valuable to you, but in essence, for a buyer, it's actually a little bit more of a risk. Okay, because you need employee A, B, and C to stay because they're key people. So that's something that a lot of business owners really like. So yeah, we've had our team that's been, our team of 10, we've been with us for over 10 to 15 years. That's quite valuable. That should be, yes, it is a good thing if you can retain them, but also if you can't, it's not really factored into the valuation, right? So yeah, they're probably the two main things. The other thing as well is that you may be earning money, and we sort of touched on this last week, and the working capital requirements. Okay, so like if a buyer comes in and says, "Great, the business is earning $500,000, but I've got to go tie up, $3 million of stock to sit on the shelf." Well, that's going to devalue the business because it's not going to be as appealing. So versus an asset light type SaaS business that's got minimal employees that is highly scalable, right? So that's something that needs to be addressed, and also it could be improved prior to the sale. You could minimize the amount of carrying value of stock, and be able to make that a little bit more appealing if a buyer was to come in and say, hey, look, we want to buy this business based on the revenue and the profitability, but also the other side of it is we don't want to tie up a lot of because capital requirements are going to go up, and it means
And we're talking about just some pitfalls, especially like like someone might turn around and artificially inflate the valuation of their business by reducing their pay, reducing their ad backs, like there's all these. So, what would your advice be, or just some thoughts around, if you are trying to artificially increase your valuation? I mean, because that will get broken down pretty quickly in a really solid DD process. What's your sort of some thoughts around that? Because you see it all the time. I'll see, like, I'll jump on TikTok or whatever, and so on. We'll go through the businesses, and they'll go, well, actually, these numbers don't quite stack up because that means the owner's not paying themselves, and that's not correct. All they're doing is inflating the bottom line to get a better exit outcome. So what's your thoughts on that type of behavior? Not behaviors, I suppose, but those type of ways that people are going about that.
Yeah. Okay. So I think the main thing is like, look, a valuation can be done not just for the purposes of selling a business. You could go in and try and get, a loan off the back of, a valuation. You want to bring in business partners and so forth, or you want to, issue equity to somebody within the business. So you want to make sure that you've got, a clear picture of what the business is making, the expenses, the cost structure, and everything. So the common pitfalls to address early. So, our advice would be from the day, if you've got a valuation or you're thinking about selling, really start to look at, putting more attention to your bookkeeping. So that's probably the main one we find that, hey, sloppy bookkeeping, you're doing it yourself. Where's this expense item supposed to be located, and it's put into a more vague type of line item like maintenance and how that's broken up. So we want to make sure
entertainment.
Entertainment. Yeah. So look, I guess what it comes down to is that if you're looking at selling, or you're looking at obtaining finance, or you're looking at using and just showing your financials, like really simplifying it and making it really clear for somebody, even in the due diligence period, for a bank to say, okay, we know exactly how much income you're actually earning, and then we can offer you a loan based on that. If you've got really opaque financials, or you've got things that aren't clear, they need to be clarified. So you could improve that from day one. Say, yeah, okay, what I was doing for the last 2 years is probably not going to fly. It's probably going to throw up more questions than it is going to answer. So what I could do is I could actually start to clean that up and add some integrity into the financials. So that's one of the things that any business owner can start straight away. If you're doing it wrong, or you're doing it in a way in the past, you're looking at from now on, we're going to do it, we'll clean up the financials, take away a lot of the excessive. The other one is excessive personal expenses in the business. If you've got too much excessive personal expenses, and you've got $600,000 of add backs, well, that's going to throw up a lot of questions. It's going to be a little bit of a red flag. You don't want to have too many expenses running through the business as well. If you had it in the past, yes, it's good for tax minimization, but you can't have your cake and eat it too, right?
I was going to say it's a cake and eat it too situation, isn't it?
Yeah. If you're selling, just make it really, really clear for any acquirer to be able to clearly define and make it really, really easy to see what your business is making, and their advisors as well. And because when you go through the long list of add backs and start verifying all that, you start to go into a territory where it becomes a little bit it becomes more complex, right? You're explaining, you're batting off, all these, this is for this is for that. Let's just clear it, clean it up, so it's really easy, right? The other one is that we talked about this last week, which is the high owner reliance, right? So if you've got a lot of reliance on you, you're a key person in the business, maybe there would be a case for starting to groom more of a 2IC, a second in charge, to be able to come in and potentially take in some of these roles that would potentially stay in the business, because a new acquirer would like to come into the business and say, great, we've got the 2IC, we're retaining him or her, and they can actually, at least they've got the knowledge, and they can, and the relationships with the people under them, to be able to carry on the business as usual, right, after acquisition. So that's a really key one. If it's not, you don't have someone groomed, or you're not 2IC, well, guess what's going to happen? You're actually going to be retained in the business for a period that you're probably not going to be happy with, like a year or two after.
Yeah.
And one of the things, the pitfalls is that you're running the business for 20 years, you're the boss, and then all of a sudden you come in and you're an employee, to take orders for someone half your age, maybe, or maybe that you think that can't run it as good as you, and you're probably right. And you are now an employee, and that's a really that's a big shift. Okay, that's something that like a lot of business owners don't consider, so that's a lack of succession planning. So having that key person risk, or really assessing, really looking at the business objectively and saying, who are the key people in the business, and what kind of risk? What if they left? What impact would they have? Do we tie them up? Do we make sure that we've got at least systems and processes and everything documented? So if they did leave, we've got a bit of a contingency. So that's comes into succession planning, and also just really mitigating risk within your business as well. And the good things about these improvements, not only do you actually improve the value of the business, you actually run a better business as well. You have a better business where you could potentially make more profit and mitigate risk in the short term anyway. Look, a lot of the time that these businesses may take 6 to 12 months to transact. So you're still operating that business and improving these things that make it a bit more appealing to an acquirer. So look, I would suggest that people would look at like more of a checklist type of approach to spot these early. To spot these issues quite early, and early engagements, is going to be critical. And just make sure that that these things that erode value are getting addressed very early, and throughout the process as well. Like, you could be on the market and you're continually improving the business. There's things that happen in the business. It's quite dynamic. But if you've got all these things fixed up at least to a level, then you can actually start to look at maintaining, and because maintaining is it takes an effort as well. You run a business, Sash, so things move, a lot of moving parts. You're always spinning plates. So if you're starting from way back and you've got all these issues and that, it's quite a lot of an effort to, if you put the business on the market and start trying to fix and plug these holes in that period of time when you got in the market. If you've got everything pre-prepared, it just makes it a lot easier.
Actually, you mentioned something then, and that's actually one of the questions I was going to ask is, so it's going to be, just say it's a 12, 18-month process for a sale, and I've currently got a business that's worth, let's say 5 mil, and I pick up a bigger client, and suddenly that client's a 3-year deal, and it effectively increases your sales, which increases you, and you don't have, so it increases the valuation of the business. Or on the flip side, I lose a customer during the process of that 12, 18 months where it actually affects the valuation of the business. So if I'm working through a DD process with a potential buyer or buyers, how does that work? Like, what I mean? Especially if it's because the business is very dynamic and things can change in 6 months, let alone 12 months. How do you handle that, number one, and sort of obviously, is there a memo of understanding? How does all that sort of work? Because that's actually a really interesting point. Because business is honestly, especially if you're a service-based business or whatever, like you lose one client and it really makes a big difference.
Yeah. Look, it's called a customer concentration risk, and it's on everyone's due diligence checklist, and that is one of the things that the advisors that are doing the DD are going to look into and drill down on. So if we talk about customer concentration risk, okay, it's how much the percentage of revenue is coming from one client or the other, or versus the rest of them. So if you've got a client that's taking up, say, 20%, 25% of all your revenue, okay, so it's a big fish. You may think that's great, like fantastic. We've got this big client, but what that actually does, it represents a risk of, if they were to leave, it leaves a big void in the business. And are you going to be able to go and get this quite a what we call an elephant type of customer versus your rats and mice. So what you find is that becomes a concentration risk. You need to talk about it. You need to be able to say, well, we're not going to. But it's a good thing because it's contributing to revenue, but it does represent some risk. So how do we actually mitigate a bit of that? So how do we look at making increasing revenue from that? Well, that's the idea, to increase revenue, to make sure that 25% turns into 5% of the revenue. All right, so you increase total revenue, or you can look at tying that customer down with a potential contract or so. So what you could potentially do is go out and say, great, you're a loyal customer. What we're going to do is we're going to basically give you discounted rates, because you're not going to go anywhere. We've got a good relationship. But how about if we would do it on a contract, and we lock in our prices, for a period of time. It would work for you, but it also works for the business owner to lock in that customer. Now, the other side of concentration risk is if you've got multiple services you provide, if you've got multiple items you provide or products you provide, right? So how concentrated is one product versus the other? So let's say it's an e-commerce business, okay? How concentrated is, you might sell, 80% of your sales might be in one product, and then 20% is obviously with the rest of the catalog. So are we looking at the product and how much sales are got to do with that product? So that may become a risk as well, because if that, a competitor would come in, or someone would do it cheaper or undercut you, or as a knockoff that came, that represents a risk. The other, and in between that, the two, customer and also product, you've also got how your revenue is actually broken up. So this is a really key part, and this is what we find is that so you've got your total revenue. What percentage comes from recurring revenue, maintenance revenue, right? Like subscription revenue every month, right? We know that's coming in, that's on a contract. What percentage comes from intermittent like you see, you might have regular clients that might engage you 3 to 5 times a year. You're the incumbent, like you contact, like let's say like you're a shopping center and you're top of the list as the electrician that comes in and to fix. So that's regular work, but it's intermittent. Okay, so you've got intermittent recurring revenue. And then what you've got is you've also got project revenue as well, right? So project revenue is like what people would consider to be the cream, right? So that's basically, and that's where you make a lot of your money. So what happens is we touched on this last week, but whereas that's highly risky because that's on a, like let's say you're building a project and you get paid, maybe 18 months at a time, but they're big packages that you get, which is big dumps of revenue. So that there's very hard to, that's not as desirable, even though that might be the cream, and that's where you make your profit margins in your project, but that's also quite risky. So whereas maintenance revenue is very regular and it's also a bit more predictable. So again, a business that had regular maintenance revenue would probably be more desirable from an acquirer, but also scaled at a high multiple. Whereas project revenue on the other end of the scale is like, yes, it's more profitable, but it's not going to be times by higher multiple because it's intermittent and we don't know when the next elephant's coming in, right? So
very similar to real estate agents. That's why they've got the rental books as well as sales, the sales revenue.
Yeah, well, that's definitely, like if you're looking at a real estate agency, for example, if you don't have a rental role, you can't sell the business, right? So because it's definitely tied up in the agents. So the agents are, they've got the ability to go out and sell, right? Unless they're willing to stay on and so forth. But that's where the key person risk is, and you don't know when your next sale's coming. And there's times where it's feast and famine, right? It's basically high end of the market. We're selling. Interest rates go up, the sales, like property sales, take a bit of a dip. But whereas the rental role, that's you're building that rental book up, and that's like there's more people that are looking at, like we want to buy the rental role, we want to buy that recurring revenue, and we want to buy that and look at bolting onto our existing rental role, and then grow that, and it's a roll up strategy, and then sell it to someone that's. That I've accumulated quite a lot of like properties and rental role, and they want to sell it as a bigger package at high multiple as well. So that's again, we won't go too far into that. But that's what's called we have multiple arbitrage, whereas people are willing to pay a high multiple for a larger revenue or higher profitability. So your business is making $2 million. That's highly desirable. So it'll size that won't be discounted. It'll be you'll pay a size premium, so you'll pay a higher multiple. So what a lot of people do, like for example, private equity and people who are acquiring, what they do is they go and roll up a lot of these smaller operators into a much larger package, and then at a 3 times multiple they're buying it, and then they go and sell to a larger trade sale at a 5 times multiple, at a larger package.
Yeah, that's so true. It's because I know some people who've got real estate businesses and they've actually moved into like getting from. They're investing a lot in their rent roll, and I asked why, and they're like, "Well, it just helps helps make the business more than just me." I'm like, "Oh, that makes a lot of sense." So that's which is really, really good. Valuations. So the interesting part about valuations is how often should you actually get them, and why should you get them in those intervals as well? Like a startup like ourselves, or a tech business like ourselves, we need to sort of get it before we do a round, like a price round. It's a bit of an inexact science at this stage because it's very speculative. But I'd imagine sort of like your mum and pops, your average brick and mortar services based business or an SME, they probably don't think about getting valuations too often unless it's got to do with some bank, banking or whatever they need to do for a loan. So how often do you think that a business owner should go and get a valuation on their business?
Yeah, it's a good question. I guess, there's different levels of valuation reports, right? So there's different levels of detail. A formal valuation is probably needed if you're going to bring on equity partners, you're looking at raising capital, you're looking at selling the business, or you're looking at transferring that business to another entity, for example. It needs to have the hallmarks of a formal APS 225 valuation. And if it might be scrutinised in a court of law or it's for the ATO, maybe used for defensibility for the ATO, it needs to have the formal valuation. So again, depending on the application, depending on why you need the valuation report, would be, you prescribe the right report. And what you have is like an appraisal report is probably on the other end of the scale, which is more like just, it's a lot cheaper. It's a lot less hours. We're just having a look and saying, well, this is an estimation of value. Maybe you're within a range. Okay. And, it would probably use one valuation methodology, maybe a market method and so forth. And then they can just find it, like a business owner might be able to find out, what my business is worth. So I'm not stating in the dark. I actually understand how much, and then I can make some strategic decisions off the back of that. And we've explained that as well in terms of going out, get the first step, getting it assessed, getting it valued. And then the whole idea is when you're getting someone to come in as an exit planner, who could be a growth strategist, is to build value in the business. So you want to quantify how much value that they can create. So what we also find is that, we get a valuation done, an advisor comes in, and then after 1 year, we could revalue the business and then say, how much value has that advisor added to the business? So how can we quantify that? And then that could be, a really good way for an advisor to sit down after the end of the year when the contract's up and saying, okay, let's renew our contract. This is what I've contributed to the business. You don't have that awkward conversation having to say, oh, well, you haven't really done anything, or, it's all been me, it hasn't been you. You can really quantify your contribution. So there's that. And in between that, you've got what's called an EOV, which is like an estimation of value. Well, this is the way we structure our 3 valuation reports in our valuation practice. And an EOV is like a bit of a hybrid between two. It's got the hallmarks of the formal valuation, the methodology and everything, but it doesn't go to the extent. But what it does is it allows a business owner or an acquirer to look at it and say, okay, well, this is what substantiates the asking price, and this is where they've arrived at that, and it applies valuation methodology, and that's really good for the purpose of selling a business. It's really good for maybe even an advisor was to come in and you could put some recommendations in the EOV as well, where they don't belong in a formal valuation report. So that could be a really good. It's a bit more of a deep dive, but that's just where we go into more the specific risk, more like your business specifically, not necessarily looking at your business in an industry and applying a market multiple, right? So it's a little bit more of a deep dive into your specific business, because every business is different, but it also allows it's easily digestible from a business owner can easily digest it. A buyer can read through it, and it's a little bit easier to read and go through. So depending on the application, really, and we always ask what's the purpose of the valuation? That's really key. And then we try and prescribe a product that's going to fit the needs without prescribing. We don't want to give them a formal valuation if all they really need is a appraisal. But just to sort of finish off and say, look, any business that's sort of under $1 million, it's a micro business, it's probably warrants an appraisal, really, or an EOV. Any business that's over $1 million, we would probably look at maybe even introducing a formal valuation. And depending on who's going to be reading it, who's the counterparty, it would depend on what type of valuation report would be best fit.
Yeah, awesome. And the big one that I even know we what we're doing here is proprietary and intellectual property. That I know, even with stuff that I've had to do, I've had to sign over that X amount of intellectual property is passed over to the business. How much does intellectual property make a difference for intellectual and proprietary property? Make a difference to a valuation of a business, especially for forecasting and that type of stuff?
Yeah, that's a really good question. Intellectual property is an intangible, so it's you can't touch and feel it. It's very hard. You don't have any comparables to be able to say, okay, your intellectual property is compared to somebody else's. It's different because it's proprietary to you, right? So it does take a different level of expertise to be able to value intangibles. There's a method that we would go through. I won't go through that today, but to be able to look at the intangible assets of a business and how much value that would be worth to the business. It is a key part, especially software, especially with even innovation and and anything, anyone's got patents or contracts and so forth. But it also extends to contracts. It also extends to like agreements and everything as well, and that are proprietary to the business. So yeah, look, there's a way you would need to assess that. You would need to use a professional valuer to value intangibles. We wouldn't suggest that business owners self-value their intangible assets or their IP, right? Because that's not. You need to look at it objectively. And what happens is the IP really is what gives you a competitive advantage. Okay, so what gives you the competitive advantage if you didn't have it or you did. So it is a way you could look at, like for example, like a franchise, for example, like how would the business operate with the franchise, like sandwich shop, or how would they operate with like being Subway? Okay, so there's a relief from royalties method that you can use. Won't go into that, but basically, looking at the differences, like how much is that brand equity, okay, worth to that business? If you stripped it away, how much it would be worth? So there's methods you can use as well. There's obviously ways that you can look at. If it's proprietary, then you look at the scalability of the business, and looking at how far and wide you can scale this. How secure is the IP from being copied, but also being, can someone else tomorrow come in? You said barriers to entry, right? Like you've got how easy it is for someone to copy Empiraa, right? And just and then start up overseas, or do you have something that cannot be copied and patented? And it's definitely like got a lot of barriers to entry. So these things need to be assessed, and they need to have a bit of a deep dive. But it's an interesting field, and it is one that we're finding more and more valuations are coming through on intangibles because a lot of the businesses are now moving towards online businesses, and I think it's the way of the world. Like AI is even with the introduction of AI, it's even more difficult because people have spent a lot of money to develop software over a period of 10 years. But it's cheaper now to develop software with the introduction of AI and just even with putting a team together. So the development costs have gone down. So do we do like a cost to create method, or do we do what the current market value is to create that same software? So it's moving at light speed. It's very difficult. And sometimes we have business owners come and say, "Oh, I've spent $5 million over the 10 years." On developers to get it to this level, and then we say, okay, well, but how much is it going to cost for someone to start from scratch and create this? So that's a really good question, and so that's becoming more prevalent. But like IP in a business is what gives you a competitive advantage, and you need to have it properly assessed, and any buyer that's quite valuable if you can get something that's going to give you that edge. That's something people will be willing to pay for.
So like trademarks, copyrights, that sort of stuff. Try and get them embedded.
Trademarks, patents, copyrights. So if you've got IP and you're looking to sell the business, or if you're looking to scale and you want to go out to the market, go and get these tied up, and that's where you'll go and speak to an IP lawyer or trademark. Lawyer to be able to get all these things like tied up, so you're protecting your IP, and then that's worth something to hand over, that could be your designs, that could be if they're proprietary, that could be rights, trademarks, as we spoke about. So
and probably the big one on that as well is make sure it's in the business name, not your personal name.
So that's a really good one. We have that all the time where if you're bringing on investors, you need to sign the IP to the company, the business, because the investors are coming on, that's where you need to sign it to the company. A lot of especially during COVID, we had a lot of people that would just start up like the sole trader, register a patent and so forth, and then you get a bit further down the line and say, okay, we're going to restructure this, we're going to bring on investors and so forth. So what we want to do is we want to make sure that it's set up from day one, but sometimes it's just easier just to get it registered under your own, the director or the founder. But that needs to happen, down the track. And the earlier you can do that, the better. If you're going to try and fix something when you're way down the line, it's always harder to do. As
And I noticed even like we've not to lift the hood too much on what we do, but I noticed like early days when I had to transfer the IP from myself to Empiraa, because also the other side of it too, if you're doing things like the Austrade R&D tax incentives, that type of stuff, it's got to be, you've got to make sure that your business is the one that's benefiting from the work, not you, if that makes sense. So it's
we've done a lot of valuations this year based on the R&T tax incentives and so forth, and just the government grants, and we see that, like, again, the case in point is people during COVID, they set up these structures, and then all of a sudden they start getting traction, and then they have to actually move all the, or if you're bringing on, let's say you're bringing on, so sometimes it works in reverse. So like you want to put the IP into a separate entity because you're actually bringing in investors and clients and so forth. So so then they go and look at moving the IP, but it needs to be done at arm's length, because what happens is that you would have a capital gains tax being triggered. So that's where it's important to make sure that you're getting a proper valuation done. So if the ATM come knocking and say, why'd you transfer this for $1? Then, they want their pound of flesh. So what happens is you want to make sure that you've got some defensibility. Hey, I'll pull out my at arm's length valuation, and this is what I transferred to that. And it just really covers you. So a lot of accountants and the like, they understand this, but you would want to get the proper advice if you're in that situation. Yeah.
And just the last thing, Daniel, what's your top 3 tips if you're looking to boost your valuation for your business, to speak to expert business, to sell your business, to make millions and millions of dollars?
Yeah. Okay. So look, the major thing is that buyers, they pay for future certainty, not past effort, right? So yep, great, you've increased, you've worked in the business for 20 years, but it's future certainty. So try and make it as much the future look more certain, recurring revenue and so forth, which we touched on. What we want to do is identify the hidden value, okay, and help the owner present it with confidence, okay. So because a lot of business sales and a lot of the valuation is shaped by the narrative and risk reduction, rather than accounting reports alone, right? Because that's one side of it. You've got two sides of the coin. We always explain that, and preparation, it doesn't just prevent discounting. It creates premium outcomes as well, right? So preparing, we're a big advocate for engaging early, preparing properly, and then what happens is it minimizes the amount of time on market, the retention, and you get a premium on the sale price. So they're the 3 main ones.
Was it preparation prevents piss poor performance? I think that's it.
Yeah. The more prepared you can be, you can never be overly prepared. But I think, being prepared, the one thing I'll finish off on is that the outcome, the secondary benefit of preparing your business is you're actually running, when whilst you're still in the chair and you basically have that business, you're actually running a better business. You might not be able to getting, all the personal expenses and so forth. You might pay a little bit more tax. But you are running a more systematized business, business that's not owner operator dependent, and it's a lot more enjoyable to run an organized business, and then you can hand that organized business over. So you are getting that benefit. And we find a lot of our clients that come in, get a valuation, and then start to build the value in their business. They actually enjoy increased revenues, increased profitability, and not having to do all the work themselves, and a lot more security and peace of mind that they've got a good succession plan or risk mitigation strategy in place in case a person wants to leave. Also, it's not stacked in. It's not tied up with the owner, and the outcomes are tied up with the owner. So that's one of the main secondary benefits that isn't really considered by a lot of business owners when they go and embark on this journey.
Yeah. No. Once again, Daniel, this has been awesome. I knew it would be. We are doing a third part, which the third part will be about the sale, and I think that's a really the sale and then what, because we've talked about the preparation, we've talked about why you want to sell, how to get the value. I think it's really important to understand the actual sale of the business and also then what happens after. And I think that's a really insightful sort of trilogy of webinars that we've put together. So, but once again, Daniel, where can they find Expert Business and yourself?
Sure. So we're on LinkedIn. We're on all the socials. So Expert Business, pretty easy to remember. But also Expert Business Valuations is our valuation firm that we that's our sister company. Yeah, you can find us online. Connect up with me on Daniel Callegari on LinkedIn. If you've got any questions or what you want to have a chat, I'm happy to engage in the conversation. Yeah, look, we do put out some content as well on the valuation side, quite regularly. It's free content. It's just really good to be able to, for business owners that are maybe looking in the future, how to improve their value. Definitely have a look at us on socials as well, particularly on LinkedIn. That's where we're posting most of our content. Yeah, that's like networking events as well. That I've met you, Ash, as well. Yeah. I'm around, so yeah, happy to always chat about the evaluation topics and business preparation, yeah, and sale as well.
Yeah, awesome. And as per usual, if you want to find Empiraa, go to empiraa.com. Find us on LinkedIn and everywhere else that the socials, TikTok, Instagram, Reels, whatever it is. Once again, thanks very much, Daniel. I'm looking forward to, in a fortnight, doing this all over again and talk about actually the sale of your business, because I think this is a really insightful little series to actually show people, the people want exits. And they want to know how they can get the best event out of that. So thanks again, Daniel, and we'll speak soon.
Thanks, Ash. Thanks again for having me as well.
No.